Welcome everyone to the Traders Desk. We are on the 24th of August 2025. Segment is only for Discord server members, but we've been a bit gracious and we'll showcase it to the YouTube channel as well, just so you understand what we do within the Discord server. Before we get started, this is not financial advice. This is purely for educational basis. Do read the disclaimer and also do read the copyright notice here. Quite a bit of volatility or choppiness, rather, in the financial markets. Not volatility because VIX is still like at the lows, believe it or not. Um, while looking at the price action, there's a few things that stand out, and I'm going to cover them today. So, obviously, we had a big rally on Friday as the Fed chair Powell spoke about how he thinks that the Fed could adjust its monetary policy according to what's happening in the economy, mainly with reference to a slowing job market. So the market looked at this as Fed becoming, as the Fed chair becoming a lot more dovish than he was a couple of weeks ago. So that's why we got a rally in equity markets. But don't be surprised to see that next week might be a totally different, mood in markets. We've seen this over and over again now, where the market has a bit of a bipolar nature. One day it's indicating that we're definitely going to get a rate cut, and then the next day it's like the total opposite. So for people who are not familiar with this, you might think that, this is just crazy. But at the end of the day, this reflects the shifting expectations of market participants. So when you see these swings in financial markets, basically what's happening is, portfolio managers are adjusting their positions, hedging, and change. Their views are changing. The future expectations are changing, and they're making decisions on their portfolio on that basis, and that gets reflected in the share prices. So one day we all love long duration assets like tech and so on, and then the next day it's like back to being gloomy in that space. But essentially, what's happening is you have people who are shifting their shifting their exposures. Maybe they used to be overweight tech, now they are reducing it. And then you have on the other side retail traders maybe punting with options, and you know the sector has a couple of good days. But essentially, I think we need to look at the markets, not with a one-day price action, but rather see how it's trending and also understand the changing narratives within financial markets. So the first question when I look at this chart here is the Magnificent Seven losing steam? So we did see this earlier in the year, around January, February, where the Magnificent Seven found it difficult to rally and make new highs. Um, this is not entirely clear at the moment, but the reason I'm asking this question will be answered in the next few slides. This is just something for us to keep watching because I think capital might be rotating and moving to other segments of the economy, especially as tech has been something that the whole market has been overweight. I mean, the earnings have been stellar too. The likes of Meta, for instance, they've had stellar earnings. Google was also relatively good. Amazon relatively good. Um, Apple probably, it's still like a boring results, but the market tends to like it because of the resilience of Apple. Um, but overall, like even Microsoft, results were relatively good. So everyone was already positioned for and positioned overweight for a lot of these stocks. And as we'll see as we go through the slides, I think there might be a bit of capital rotation out of these stocks into other parts of the economy. So uh, this is another slide that maybe you haven't seen this before, but this is a breadth analysis. So I'm basically looking at the percentage. So the pink line that you see, this one, the pink line over here. So this is basically showcasing the percentage of stocks that are trading above their 50-day moving average. So this is an indication for us to understand. And we're looking at two different indices here. So the left side is basically the NASDAQ 100. And then on the right side, it's the NASDAQ composite. The difference between the two is that the NASDAQ 100 is a more select group of stocks. It basically has non-financial stocks and predominantly is full of tech and high growth stocks. Whereas the Nasdaq Composite, it has, I think, over, if I'm not mistaken, over 3,000 stocks. And they're not all tech stocks, they're not all high growth stocks. So it's a bit more of a broader index that captures, whatever's happening all over the economy versus the Nasdaq 100, which is more skewed towards tech and high growth. And it's also important to mention that the pink line indicates the breadth of these indices, right? So the pink line on the left and the right are both similar in nature, but they are so for instance, this is the percentage of stocks that are trading above the 50 moving average within the QQQ, so Nasdaq 100. And then this one would be percentage of stocks trading above 50 moving average within the Nasdaq composite, right? So the reason I have these two side by side is that I wanted to show you this divergence in terms of the breadth analysis between the QQQ and the broader index, which is the Nasdaq composite. So I might have shared the chart on the left in the Discord server a few days ago. What we can read from that is that basically the Nasdaq 100 has been rallying while the breadth within the index has been worsening, right? Or at least, I mean, it showed a bit of recovery over the last few days. But if you look at this, there's a big gap, right? So the market has been rallying while the number of stocks above the 50 moving average has been coming down. So this really tells you that the rally in the QQQ has been limited to the top stocks, maybe the top 7, top 10. And this is basically where the Magnificent Seven lies, right? So the question here is what's going to happen? What's going to happen from here? Are we going to see an improving breadth measure in the future, which means that maybe the QQQ rallies, but the rally is not necessarily concentrated amongst the top 7 or top 10 companies, but rather the rally broadens out and then the breadth catches up and closes this gap? Or we're going to see worsening breadth in that the Nasdaq keeps rallying, and that rally is concentrated within the top 7, 10 companies. So we don't really know how that's gonna work out. But the reason we look at it is because the bigger this divergence, right, the bigger this gap opens up, I think there's more shaky ground for a correction, because essentially what's happening is that the rally is concentrated within a few stocks only, and this is not indicative of an economy that's healthy and growing, across the board, right? So as this gap gets bigger, I think the prospect for a pullback increases. But more so, we know that funds are overly concentrated in the Magnificent Seven, right? So if they decide to just reduce their exposures to the Magnificent Seven, that in itself will could cause the Nasdaq 100 to pull back quite a bit. If I'm not mistaken, I think the Magnificent Seven is probably 35 to 40% of the Nasdaq 100, or maybe 30 to 35, something like this. So it's a big chunk, right? Because remember, the Nasdaq 100 is market cap weighted, not equal weighted, right? So the bigger companies get a bigger weight in the index. Now, if we move to the Nasdaq Composite, so this is a broader measure. It's also been experiencing a rally, right? But what we see here is that the breadth measure is a lot healthier. So this really tells me that we might be looking at a case where there is capital rotation and capital is starting to go into the smaller companies and kind of the rally is broadening. That's basically what I think might be happening here. And this is a good observation for us because it means that maybe there is a reason why we should start looking at, let's say, mid caps or small caps and find these companies with good fundamentals or improving fundamentals and start researching them, try to find the ones with good upside potential. Because the market is telling you that, or the chart rather is telling you that the market is starting to look deeper within and trying to find more value instead of just buying another Nvidia, another Microsoft or Tesla or whatever, right? So and also remember, if funds start to reduce their exposures to these Magnificent Seven, they are probably likely to move into other stocks that would be smaller in nature. And they're not just going to buy stocks for the sake of buying, right? They will do their fundamental work and try to find stocks that have value to offer. So I think this is something I wanted to share with you. I hope this helps to get a bit more perspective and understand what is probably going on in the market, right? Um, then I also wanted to share this with you. So I think it was Tella who asked, what other insights you can get from the bond market. So one of the things I've been looking at recently is the performance of the high yield bonds versus the liquid investment corporate bonds. So uh, the high yield corporate bonds are much more risky or riskier than the liquid grade investment bonds, right? So we are probably looking at BB minus CC rated bonds versus, let's say, A minus or B plus, whatever, right? So the reason I'm looking at this is for a number of years, or yeah, even years, right? We've seen the outperformance of high yield bonds and even junk bonds, right? Versus the liquid investment grade corporate bonds. And that really signifies a risk on environment, right? So given the choice, people are looking towards high yield bonds versus liquid investment grade bonds because that offers them uh, a higher return potential, and they probably don't think that the risk is as much as what is priced into the stock into the bonds, right? So in a risk on environment, especially right if you have a GDP growing environment, then people will be optimistic and downplay the risk versus the returns. And also, in a GDP expansionary environment, it's not impossible, but it's harder for companies to go bankrupt and to default because they tend to have improving cash flows and improving KPIs as GDP expands. However, if we are at a turning point where maybe GDP is going to slow down, I'm not even talking about GDP collapsing, but if we have a GDP slowdown environment, I think it would be normal to expect that capital starts moving out of the higher risk end into more liquid investment grade bonds. So for a number of weeks now, what I've seen is that the liquid investment grade bonds are starting to outperform the high yield corporate bonds. It's not yet clear how this is, whether this is the start of a new trend. But if that happens, I think this would be our signal that the, you know, no questions asked risk on behavior might be coming to an end, right? And that the market might be starting to position a bit more defensively. And that would mean that equity markets will also move accordingly. So we've seen a lot of stocks where they've had bad earnings and they still rally. And that's basically the market saying, yeah, this is the past, the future is going to be better. So I'm betting on the future. And it's basically like lax behavior, right? Just expecting that an improving economy is just going to make everything better. And 12 months later, the company will be, you know, beyond all the challenges and the share prices will be much higher. But if the mood is changing, right, this is something we need to watch. And if you were to plot this, and you can do it on in your own free time, if you were to plot this, this is basically February, January, February, March, April. So this is when we had the big correction in stock markets. And if you were looking at the relative outperformance here, it would have, told you somewhere here that the risk on, no questions asked mood was ending in markets, and it just got sour and sour and even worse later on. So the question is, have we peaked somewhere here or even here, and now maybe we move a bit lower? And if that happens, I think it paves the way for a correction in the stock markets, or at least, right, bad quality stocks will have a bit of reckoning. So, do we have any questions here?
No.
Okay, no questions, right?
Roshan, like the last 3 weeks here is showing a green print, right? So does
Yeah,
it
but
still mean that it's going to come down?
look, what we care about is this, right? The trend. I don't know where it's going to go, right? If it goes back up here, then I'll take that as my cue that risk on is here, and I'll change my sentiment accordingly, right? And start getting a bit more bullish in the markets. But really, what I'm watching here is the inability to go above this 200-day moving average. And if
Okay.
this goes much lower here, I mean, if this, it could just take one day, right, to go from here to here, right? Um, and keep in mind, we have an inflationary scare, right? So inflation is not great for bonds in general, right? So I think that's also what's caused the liquid investment grade bonds to not work that well, because um, with high yield bonds, right? It's it's closer to an equity than what a liquid investment grade bond is. It's a bit hard to explain this, but a liquid investment grade bond, it's closer to a bond than to an equity, right? So high yield grade bonds will actually respond quite positively if you have, uh, inflation that's going a little bit out over the target, because that also means that companies are able to get higher margins. And uh, basically the high yield bonds are just concerned about the risk of bankruptcy or delinquency, right? So if you are in an environment where inflation is gonna ensure that your cash flows get better and better and better by virtue of you passing the price through to your customers, getting higher margins and so on, then the high yield grade bonds would love that. But if inflation goes out of control to such an extent that this kills demand in the economy, then it puts those cash flows at risk, right? So let's say if the price of bread goes from, I don't even know what it is in the US, right? Let's say it goes from $10 to $30, right? uh, it doesn't mean that you should start buying bread producing companies, because people might just say, okay, I don't want to buy bread because it's far too expensive. So in that situation, it becomes a bit more of a risk for the high yield bonds. But don't think about all this complexity. Look at this as a way for the market to of telling you that um, if this line goes up, it basically means that we are risk on. We don't really uh, want to play it safe, right? And if this line goes lower, it indicates that the capital markets are now starting to think about risk a bit more and that they will be a bit more on the defensive side of things. And you will see this happen in equity markets too. So I think a few months ago we discussed that what we were seeing in the primary corporate bond market, which is basically think of it as IPOs for the equity market, so new bond issuances. There was still a lot of capital chasing those deals, and companies were able to raise capital fairly easily at quite competitive rates too, despite the high rate environment and so on. So there's a lot of capital still out there chasing for return. Um, but that might not always be the case, right? And if we are at a turning point, we need to look at these indicators as a way to kind of identify and then just sit and wait until we get a clear signal from these indicators. And as always, it's not one chart that will tell you the whole truth. It's a combination of all of these. Um, and once you've figured it out, you probably will be a couple of weeks ahead in equity markets, and you'd be able to position yourself with a great degree of likelihood to win. All clear?
Yeah.
Um, let's look at the US 10-year yield. This stays stubbornly high. It closed at 4.256. You would recall that for a couple of weeks, the market was not paying attention to this, and tech stocks, long duration assets were just rallying willy-nilly. And then they got a reckoning in the middle of the week when the FOMC minutes were out, and they realized that the Fed is actually thinking about inflation, and they are not as dovish as they thought they were. At the same time, we had the CPI print with the PPI print, which were quite inflationary in nature. So that kind of soured the whole mood. And now where we're sitting, the 10-year yield is sitting at around 4.26. So one thing that we need to keep watching here is what happens if the Fed announces a rate cut and then the long-term yields either don't move lower or they go higher, because the bond market is saying, look, you're just playing us now. There is inflation and you're cutting rates while there is inflation. We do understand you're trying to save the job market and the economy in general, but we cannot ignore that you're running inflation very hot, way above your target. Uh, and if you want to if you want us to lend you money, you'll have to pay a much higher rate to compensate us for the risk of running inflation way ahead of what you've set your target of 2% at. So this is something that's happened in the past, and uh, I think this is a likely scenario. We've also seen this happen in the last two times that the Fed has cut rates. So the long-term rates have basically not really moved down a lot, right? Even if the Fed has cut 50 basis points, um, the long-term rates have not necessarily budged by much. So the way to think about it is the Fed can only impact the short end of the bond market. So the Fed can only impact short-term bonds like 3 months yields, 6 months, 1 year, 2 years. They cannot impact the 10-year yield because the 10-year yield is basically set by the market participants. Um, you would recall I've spoken about these bond auctions in the Discord server. This is basically where the government is raising new debt, right? And they are looking for more capital, and then it's a bit like an auction that happens, right? And it's basically bond market participants, setting the rates for long-term interest. So that's something to keep an eye on because the long duration assets will be very sensitive to this rate. Yeah. So not just long duration assets, but also sectors that are interest rate sensitive, like housing. Um, the housing market depends on the 30-year mortgage rate, which in itself is a derivative of the US 30-year yield. So you also have the US 30-year yield, which you can plot and see where it's going. This will give you an idea of whether mortgage rates are going to go higher or lower. So if my hypothesis is right, whereby the Fed cuts rates, but the long-term yields don't budge, then the housing market is in for a reckoning because it means that the long-term or the fixed 30-year mortgage rate might not budge a lot and it might even go higher. So it's probably at 6.7 at the moment. I haven't checked in a while, but it should be around that range. But what if it stays at 6.6, 6.7 and doesn't come down? Is this going to stimulate demand for housing? Uh, I don't really think so, right? And that's the reason why these yields are so important to watch. I think we also looked at the yield curve and how it was shifting up and down over, let's say, a 4 weeks period. And we showed that the equity markets also move in the same way, right? Or there is a reaction function between how when uh, the yield curve moves up or moves down, right, over a period of time, that also impacts equity prices, mainly long duration assets like tech, software, um, small caps, and so on. Um, we've also looked at this before. This is the corporate bond yield spread. So this is basically a measure of how much uh, excess uh, above the risk-free rate the corporate markets are charging. So when this line goes higher, it means that the corporate bond market wants a bigger premium, or it thinks that there is more risk in giving out the loan to corporates. And as the line goes higher, as the spread goes higher, it means that the capital markets are thinking that it's getting riskier out there, and you would tend to see this line go up if you have a GDP contractionary environment. At the moment, it's still quite benign, right? It looks like it might be ticking back up, but there's nothing conclusive yet. But if this keeps going, if this goes higher from here, you should expect the VIX to ramp up and to have a sell-off in equity markets, especially amongst low quality stocks. This has been something that has almost been uneventful for a long time. And it typically is like this. So it is uneventful until it becomes, the center of attention. We saw it earlier in the year where this was kind of benign, and then in a couple of weeks, it just shoots up to the sky, right? And this is basically linked to tariffs and all this nonsense that was going on at the time. So just to recap, if there is anything like an event, maybe uh, if we believe that inflation is going to cause margins of corporates to go up, then this is going to lead to the spread to tighten, that is to go lower. But if we believe that there is an event, let's say a GDP contraction, that's going to cause a worsening of credit, a worsening of free cash flows in corporates, and by virtue of that, worsen corporate earnings, then the bond market is going to want a higher premium for the extra risk that they think is in the market, right? So another example, let's say you're lending money to an oil producer and the oil price is going lower. you're not going to charge, a spread that is not reflective of that risk, because as the price of oil goes lower, that oil producing company is getting closer to bankruptcy, or getting closer to a position where the net cash flows are tending to zero and even going to negative, right? As a bond investor, all you care about is that you will get your coupon payments and eventually your principal payments. But if the company's cash flow is going down, and there is no sign of recovery, then it's a bit more of a risky venture, right? Um, this is from the Chicago Fed. It shows us the financial conditions index. So as you can see, financial conditions have been as loose as ever, right? So for all the people who bitch and moan that the Fed is, too restrictive and all of that, I think they should just look at the charts of cryptocurrencies, the stock market. Look at this chart. There is, if you look at global liquidity, even um, nothing is suggesting that the Fed is too tight. I mean, um, to a large extent, I think the Fed should be hiking. Uh, it's a very, very, very divergent view from everyone, but I think the Fed, if it's like true to its dual mandate, it should actually start hiking. Go ahead, Tella.
So it's not clear what this chart is showing. So how to read this?
Oh, sorry. So the way to read this is, if it's positive above zero, the more positive it is, the tighter the financial conditions. And then if it's negative, that means it's looser. I think if you go to the website, it has the definition at the bottom. So let's just quickly get that right. So this is from the St. Louis Fed, and you can see here, right? Um, so this is a comprehensive weekly update on U.S. financial conditions in money markets, debt, and equity markets. Positive values indicate financial conditions that are tighter than average, while negative values indicate looser than average, right? So typically, these gray areas, they would tend to indicate recessionary periods. And you can see how in those periods, the financial conditions get much harder or much tighter. This is basically something as simple as banks are not going to loan anyone money. They're going to be very restrictive and have lots of terms and conditions. Um, Maybe they would want more collateral. Unsecured loans will be far more difficult to get. They're going to reduce the revolving credit facilities of companies. So maybe JP Morgan gave you 800 million last year as your revolving credit facility. Now they look at it and they chop it back to 200 million, right? So a lot of companies, when you look at the investor presentations, they will tell you that we have plenty of liquidity ahead, right? And they will say we have 200 million cash, we have 100 million or 800 million from the from the revolving credit facility that we can use if there are opportunities ahead, or if we have any troubles along the way. So liquidity is not a problem. But as they start reducing or enforcing a lot of these measures, then the companies will also find themselves in situations where liquidity conditions are tighter for them, right? So in that situation, they have to be very mindful of how much financial leverage they are running. Because typically what would happen at that time is also that business is going to get more difficult. So the growth rates are going to come down, maybe go negative. Um, so Amin says money supply empty is a good indicator of liquidity. Yeah, that's right. Yeah. You can also use that. Um, and then you can, some people use moving averages on the M2 monetary supply measure. Um, what I typically do is I look at the, because the M2 data, I think it's published weekly, right? So what I would typically do is look at the week on week movement and then annualize them. And generally, you would tend to see that a few weeks before a proper crisis, the Fed will start to increase the M2 supply. So if you annualize it, you will typically see that this gets much higher as we get closer to let's say a crisis. We can probably even do that here. So if we do, it's also maybe a good exercise for you to, you can plot 90-day lag. Yeah. So I'll show you what I typically look at. So no, this is not the, I think this is the one I'm looking for, yeah? Ah, they've discontinued it. Okay, never mind. So typically I would look at the weekly movements, annualize them, and then I normally do it in Excel. So I would download the data and then just do it on my own. I would do percent change, and then to annualize it, I'll just multiply it accordingly. But what I wanted to show you is probably this. So coming into a recession, you would typically see the Fed increasing this measure quite significantly. You don't see it here because it's not shown in an annualized format. So you don't really know what is a relative average weekly increase and what is like an outlier weekly increase. But if you do it like a statistical analysis, you should be able to see that this is actually an outlier or an outlier few weeks even. So let's move on. So we don't. What's going on here? Just bear with me. Okay. Yeah, I still wait here. Okay, there we go. Sorry about that. So let's look at the equity performance across sectors. So the S&P has been up. Oh, actually, I've got my rectangles wrong here because I looked at this rate rather than the weekly rate. So ignore the green and red rectangles. So the S&P was up 0.29% on the week. And so basically the outperformers would be anything that's positive, right? So it's only these two sectors that are underperformers. I think we need to start looking at the communication sector. Darren and myself were speaking about it over the week, and Darren has been looking at the earnings of the likes of Coherent and Fabrinet, which are predominantly like network equipment producers or manufacturers. So these companies got given like a second life, right, with this whole AI data center build out. And if you look at the recent earnings, it does look like there has been a bit of a slowdown happening there. So the question I was asking myself is, are these like the early signs that maybe this whole AI build out is probably slowing down, or at least in the network equipment segment, right? Because I was also reading an article the other day that was saying that sure, people are buying more GPUs, but it doesn't necessarily mean that you will need more switches, more optical transceivers, and so on, because these transceivers have relatively high capacity. So thinking that adding more GPUs mean that people would add more of these networking equipment. It's not necessarily the case. And the same applies for the high bandwidth memory. So this is kind of something we need to look a little bit more in depth, because you might have good short opportunities here with companies that have gone um, kind of X growth, right? It's quite interesting to see the tech sector being the biggest underperformer. I think within individual stocks, we've seen a bit of sell-off within the SaaS segment. So the software as a service segment is going through a bit of a reckoning, and all of that is happening after earnings. Some of them have had relatively good earnings, but still they are selling off. So I'm not sure what's going on here, whether this is just benign profit taking or whether people are reevaluating their views on SaaS and probably thinking that SaaS is going to get disrupted by AI. I think it's more of the latter because, I mean, if you think about it, right, um, software gives employees a way to capture data and then to interact with the data and then use the data to do something. Whereas AI agents go one or two steps further, whereby it does everything that the SaaS will do, but it's also got the ability to do the thing, right? So as an example, let's say you have a bunch of clients with outstanding invoices. Typically in the SaaS world, an employee would get the report and flag the five clients that have outstanding invoices, then maybe send them an email or call them up. But now an AI agent will still do the same procedure, but it's also able to call up these guys or send them automated email reminders and so on. So this is where I think there's a big game. It's a big game changer that's happening in that now it's going to do things as well. And for the SaaS companies that are not innovating in that from that perspective, they're going to get disrupted massively by AI first companies. And I think the market is coming to that realization and probably rethinking the kind of premium they allocate to these types of companies. Premium in terms of PEs or valuation metrics. In terms of outperformers, energy did relatively well, despite the oil price not necessarily recovering a lot. I think we need to think about the price action here in terms of what happened on Friday. So there was a lot of short squeezes, a lot of short covering. So a lot of the outperformance that we see here might not be outperformance on the basis of people buying due to improving fundamental outlooks, right? It might just be short covering, short squeezes. So we have to discriminate between the two, possibly, right? And understand that the ones that are happening for fundamental reasons, they are likely to keep continuing. The ones that have happened due to technical reasons like short squeezes, indiscriminate buying because people are short and they have to cover their positions. These ones are very likely to stall and then eventually reverse. So if I look at it, I think I would tend to combine the monthly performance with the weekly performance just to get an idea of whether, we might have seen like a one-off short covering move that creates this outperformance. So sectors that I really like, materials, industrials, consumer discretionary, financials are making a comeback as well. I think people are kind of repositioning for this whole deregulation theme. So this is something that was penned down for the second half of the year. And if the economy is going to do better, it probably means more loans, more fees, more money for the banks, right? But if you're looking at the financials, financials does not necessarily equal banks, right? Financials is also insurance. It can also be brokers. So there's a whole mix of things there. And it might not be a good idea. It might not be a bad idea to start looking at other things, especially if we're going to have a little bit of, inflation running higher or hotter. So as an example, right, we know that insurance cost is going up, right? Either because, let's say, inflation is going to bring them higher, or because, let's say, for instance, property insurance, it's going higher because, let's say, inflation is causing property prices to go higher. Or um, if we look at, let's say, a segment like car insurance, right? Um, the premium is reflective of the claims cost, and the claims cost itself is reflective of prices of auto parts and all of this. So basically, the replacement value of the car, and if that's going higher due to inflation, you would tend to see premiums going higher too. So in that situation, would you go long the insurance company? That could be one idea, but it's probably a better idea to go along a broker that basically doesn't take the claims cost risk, but just takes a cut of the higher premium, right? So the broker does not have to add extra staff to earn extra revenue. And that's a form of operational leverage. I think we've spoken about this a few months ago when we were thinking about this whole topic of companies that benefit from inflation. Um, I've been speaking to a few guys who own companies in the US, and they were telling me that the health insurance costs are going up on average 30%. That's massive, right? And that's a combination of medical cost inflation, combination of claims cost going through the roof, but also a combination of, the subsidies from the government going lower. So some people were, let's say, on these Medicaid, Medicare schemes, and they were getting huge subsidies, sometimes up to 70% from the government. And now with the new rules, maybe they don't qualify, and they have to increase their, their the premium they pay quite significantly. I think, Talha, you would have seen this in Oscar Health, right? So if
Yes.
you study what's been happening, it's a bit of a landscape change, right? And it probably means either these people would choose not to have medical insurance, or they will pay up and basically pay much higher premiums, right? So it could go from anything from like $10, $20 per month to hundreds of dollars now, because the subsidy has been taken out, right? So these are the things you have to think about. The real estate industry is also another one I was thinking about, mainly in terms of REITs, uh, within the context of interest rates going down, right? So what does this mean for REITs? I think it's a bit of a mixed picture. You could make an argument that some of them should be re-rated upwards, because REITs are basically like it's literally like a cash flow discounting vehicle, right? You've got dividends, you've got the cash flows that are coming from the assets owned by the REITs. So if you think about it, interest rates going lower should probably mean a higher value for the REITs. But it's not as simple as this, because under the hood, there are also things that are happening in terms of sometimes maybe the property values are going lower, especially within the commercial real estate segment, or occupancy levels are coming down. So there are all these factors to consider. It's not just like interest rates are going lower, so just buy any REITs. So if you get involved in that trade, make sure you do your work properly, and you identify the risks and understand exactly what you're buying, right? Yeah, so I think another thing, I was looking at the chemical segment during the week. There are some stocks that are up like 10, 13, 15%. So I'm kind of asking myself whether this is not becoming like a fertile ground for bargain hunting, right? Um, because let's assume we have one scenario where the economy holds up and, recovers and gets a boost, right? So we're going to need a lot of these foundational industries like chemicals, right? Let's say auto manufacturing picks up. You'll need a lot more polymers, a lot more of these, all these plastics that's used for the dashboard and all these components of vehicles. So companies that are involved in this value chain, they have been beaten down to death, right? And it's very likely that we can pick a few of these and get, quite interesting upside in some of these companies. I mean, these stocks are not priced with a lot of volatility in them. And if they move 10% in a week, you're going to be very happy holding call options there. Any questions before I move on? Okay, doesn't look like it. So let's move on to the industry performance. I'm just going to rush through this because, again, I've wrongly labeled my rectangles. So you can think of it as it's only the last three industries that have underperformed the S&P 500. And again, we see the same trend, right? Internet and software are basically tech stocks. And then semiconductors probably having a bit of a correction. Um, Within semiconductors, I think we need to do a bit more research because there might be an opportunity that if Trump goes on with his tariffs on semiconductors that are imported into the US, some locally based companies that are manufacturing semiconductors or involved, in this whole value chain, they might get a boost from that. And the semiconductor manufacturing value chain is quite complicated. You could have opportunities within software. There are a few companies that uh, are, it's probably three companies within that space that kind of dominate the whole thing. Um, there's also opportunities within packaging of semiconductors. So it's not necessarily manufacturing the semiconductors itself, but making sure that you're packaging it correctly in a sterile environment. There's no static, it's not just like taking it and then putting it in a piece of plastic, right? It's a very elaborate process and you need elaborate equipment to be able to do this. And there are companies that are listed that are involved in this value chain. So it doesn't necessarily always need to be like an Intel, Micron, or any of these bigger companies that you might not be able to understand properly. It can also be simpler companies, maybe within mid cap, small cap, that are involved in a small part of the semiconductor manufacturing process. Um, these are the areas where you will have outsized opportunity. And I can show you one here. I should ideally keep this for our segment, but let's be a bit generous. Uh, and this is a company that I had in the watchlist section, and you'll see it's under the research tab. So UCTT, it's a 1 billion market cap company. Uh, as you can see, people don't think much of this company. But if there is going to be a resurgence in semiconductor manufacturing in the US, what does this company do to start off, right? So they supply critical subsystems, components, and parts, and ultra high purity cleaning and analytical services for semiconductor industry. So, you know, think about it this way, right? My not Intel, but anyone who's manufacturing even the basic semiconductors, right? You have to do it within very strictly controlled environments. And Ultra Clean Holdings is basically going to be supplying these equipment and components. And it doesn't necessarily do or manufacture uh, the semiconductors itself, but it will supply, components, parts, and all these like high purity cleaning equipment, right? So if you think about it, when you're manufacturing semiconductors, you need not only a sterile environment, but you also need to be able to test, right? Test this equipment, and you have specialized testing and analytical equipment that's used within that space. Okay, 1 second. Someone sent through a message. Onto innovation. I haven't looked at them, but maybe if you think it's a good idea, yeah, yeah. Eh, Let's see. Is the market even paying attention here? Yeah, it's a similar kind of price action, right? It's been dumped, and then no one's really paying attention to them. Had a bad earnings, but the market recovered fairly easily. So, as stocks are sold off and get to to relatively low valuations, then the long-term investors, they start looking at this and they're like, are we getting a good deal here, right? Because they're not buying to sell, let's say, in 6 months' time. They're buying to sell maybe in 3 months' time. And they are basically looking to see whether if I buy it at 108 today, can I sell it for $400 in 3 years' time? It's a much better deal now than when it was trading at 230. Yeah. So this is where, I mean, maybe it can fall a bit more. I haven't looked at the company before. But these are the types of companies, right? You should look at the value chain and understand which are the companies that are likely to get a tailwind from whatever Trump is proposing. It's very important to stay in touch with these because that's basically where the outsized opportunities are going to be. It's not going to be in buying Tesla, Microsoft, and all that crap. Okay, I'm not going to go too much into depth here. I think one thing that's worthy of note. So home builders are having a stellar month, and then they've also had a stellar week. Obviously, I don't think this is going to continue for too long. I might be completely wrong, but if we get the rate cut and then people realize that nothing much is going to change within the housing market dynamics, then it might be a situation where they start taking profits from all these for all these gains, and it might even be a situation where people start to get short again. So we need to pay attention here. I'm not short at the moment. I think we need to pick our spots here and really wait for this to get to an exhaustion point and then get involved. For us, it's all about risk reward, right? If I'm able to short it at, let's say, 120 versus 110, it's a much better place for me. Solar also had a good week, a good month also. So it's all coming on the back of regulations not being as punitive as they was initially thought of. So solar is a sector where, or an industry rather, where a lot of stocks were beaten down. Some of them for very good reasons. A lot of lawsuits, a lot of Chinese companies that are not necessarily in compliance and so on. But the whole space was battered down, right? And that's an area where it's good to do some fundamental work and understand where is it that the market might be missing a trick, and you might be able to position yourself ahead and generate massive upside. And this is basically what we've been doing with Shorts Technologies, right? I think you have a blueprint in the Discord server. You can just use it and apply it to any other companies within that space, or even, outside of that space. But choosing not to do anything with that and just looking at the chart or, whatever, uh, anything that's inaction is almost like a sin, right? And then finally, in terms of factor analysis, so on a weekly basis, we've seen a resurgence in small cap. We still small cap value. So people are not just buying willy-nilly. They are doing their work and making sure that the companies they're buying are able to deliver fundamentally. So if we have a rate cut, that's going to be a big macro tailwind for the small caps, right? And that's the market positioning ahead of all of that. Quite interestingly, we've had a sell-off in large cap growth. This is a segment that has been holding up for many weeks. And if you look on a monthly basis, the large cap growth segment is almost flat now. So you've heard me harp about capital rotation for a number of weeks now, and I think we are seeing this pictorially here, right? If you look at what's happening, right, capital is moving from the large cap growth segment into mid caps and into small caps. Yeah. The market itself hasn't done much, right? It was up like what was it? 0.29%, right, on the week. But the money is moving into different pockets. That's the important thing to realize. I also wanted to show you this. This is agricultural commodities. So the only two or maybe three commodities that are doing relatively well, it's feeder cattle, live cattle, and soybeans. So the reason why we see beef prices through the roof is because of the first two, right? So the reason you're winning with shorting Shack, it's because so if you are following, let's say this is like the leading indicator, right? This gives you confidence that the beef prices will keep going higher, and eventually you know that Shack's valuation relies on high growth of both revenue and EPS. But if the beef prices go higher, Shack cannot increase its prices much more. Its margins will get cut. So the EPS growth will come lower. At the same time, we know that consumers are spending or a bit more reluctant to go to restaurants. That's kind of the most discretionary segment, right, in terms of spending. So you have like a convergence of all these different factors that make it a great place to be short a company like Shack, right? Um, and the reason why we look at this is, let's say we want to go long fertilizer stocks or something related to farmer, like farming equipment, tractors, and so on. I don't think it's a great environment to go long, these companies because the agricultural commodities are not necessarily going higher. So why do we care? Because if agricultural commodities are not performing, farmers are not going to spend a lot for the next crop season because they're not expecting to get, a lot of money for their produce. So the capex cycle for farmers is very much related to where agricultural commodities are headed. And at the moment, it doesn't look like it's headed much higher. Okay, so yeah, so I'm going to move on to our segment now. This is purely for the Discord server members.